Hey guys, what's going on? Welcome back to the show. My name is Leo, and in this video here, we're going to be doing an analysis on Smith & Wesson. You've definitely heard of this brand if you are a avid gun user, or if you haven't heard of this brand, I'd be very surprised. So without further ado, let's roll the intro, let's jump right into Smith & Wesson, and we're going to find out a proper price to pay for this company and where it stacks financially. Here we go. A couple of lovely users on the value investing Reddit community asked me to evaluate the stock. So if you're one of those, or a few of those people, here it is, guys. I said I'd keep my word, and I'm gonna do this stock for you guys. Load it up in my software here. I'm very excited about this category. We're all green across the board. But before we jump into that, I want to jump into the company metrics first to try to get a comparison of where the company is over the last, or where the company was over the last 5 years, and the direction they're somewhat going in before we jump into our financial evaluations. But without further ado, let's jump into the company metrics. So with our PE comparison to our 5-year average, it's dropped by a considerable amount. We're at 2.91 compared to 14.85. That's a huge drop, but I love to see both of these numbers are healthy to me. Now EPS has been an increase. ROE, we have 79 compared to 24. That's a huge jump. That's great to see. Profit margin, also a huge jump from 24 to 6.87. Revenue is sitting at around $1 billion. Net income $247 million. Free cash flow $227 million, with an average free cash flow of $100 million. And our dividends paid out is $8 million with a yield of 1.94. So folks, dividend is secure. At $8.2 million, our average free cash flow being $100 million, they can easily pay off those dividends, no problem. Return on invested capital, 83% compared to 26%. There's huge jumps in this company. I love it though. And Almond Z-score, a 9.34. We want this over 3, folks. So having such a high number is really good. It's, their risk of ever going bankrupt in the next few years is pretty much nil. Finally, our P/E score is 7. Ideally, we want this between 8 or 9, but 7 is not a bad score either. 9 is the absolute highest that we can possibly achieve. All right, so based off this section here of Smith & Wesson, loving it so far. Loving it. Whoever recommended this stock, good eye so far, guys. There's a lot of huge jumps here in all the right places. Like the PE going down, this is a really low multiple. So now I'm wondering if I just go to the income statement. So they've had steady jumps in revenue, but they've been jumping up in 2021. Interesting. Our dividends are safe, high P/E score, and a really high Almond Z-score. So far, I'm liking Smith & Wesson. Let's go on to our financial valuations category to determine where this company is currently ranked within the software. And I mean, look, guys, we have a perfect 10. It's hitting all of our metrics. A PE average of under 22.5. Current ratio being 3.23. Guys, we want that to be over 1.5. And hit being over 3 is phenomenal. It does get a little bit concerning because now you have, and not concerning in a bad way, but you kind of wondering where they're putting their capital, because now you have all these assets on hand compared to your liabilities, and how are they leveraging those assets? That's one thing I would kind of question, but these are phenomenal numbers. ROE average is 24.05. We want that to be over 15%. We have that. EPS growth, as we've mentioned earlier, it is increasing by a considerable amount. Debt to equity, super low. 14%. They're leveraging all their capital through equity and not through debt, which is phenomenal. Share dilution, it's lowering the amount of shares outstanding by 0.67%. Not a huge drop, but a drop nonetheless, so it's going to get a point from me. 5-year net income growth, 97% increase. So we're increasing our net income, our free cash flow growth, and our revenue growth. Now, I want to say that, let's see our free cash flow, because revenue was kind of bouncing all over the place, and it seems like our free cash flow has been as well. It seems like it's somewhat inconsistent. It's not the most concerning thing, but it's an increase nonetheless. If we had this increase of revenue or this variable revenue growth and free cash flow growth where it's kind of bouncing up and down over the last 5 years with high debt levels, I would be a little bit more concerned. But for the fact that debt levels are incredibly low, I'm not too concerned. I'm not gonna get hung up on that. Yeah, low debt compared to what they have. So here's the thing with like Smith and Wesson. Like to be honest, like this is a company that's just out of my circle of competence, right? I mean, like I never shot a gun, so I wouldn't know. All I know is that this brand is a recognizable brand, right? And they definitely have a strong following. If you're gonna go potentially buy a gun, like granted, like if I had to go buy a gun tomorrow, I'd probably look for a Smith and Wesson just because they're that iconic. With that being said, let's jump into a price analysis to determine a proper price to pay for this business. We're going to be, as always, ultra conservative with our assumptions here because we have a lot of numbers here just jumping up and down. And if you like the video up until this point, please hit the like button and the subscribe button. It helps out the channel a lot and makes me feel warm and fuzzy inside. So with our assumptions here, I'm definitely going to hover around this 5-year number, but I'm going to probably go 9, 10, and then 11. I know they've hit it in the 10-year number, the 5-year number. I want to just account for the inconsistencies that the company's been bringing forward the last few years. Profit margin. See, our 5-year average is 6.87. 10, it's 8.79. So I might just do 6, 7, 8. With a free cash flow number of being, let's do 10, 10.5, and then 11. Price to free cash flow, 3, 4, 5. And price to, or PE ratio, I feel like I should hover around this 5-year average. It's a small company, like if relatively speaking. But I don't see how they can potentially rapidly grow. I might go 2 on the low side, 5 on the high side, 5 on the moderate side, and then 8 on the high side. Like I feel like even that might be a little bit odd. I might just do 6 and keep that at 4.5. I can't imagine this PE ratio going into like the 10 or 12 range. And then the desired return, we're gonna put this at 13%. Dude. Look at that. Look at that. Current price is $14.97, and our average calculation comes out to 28, 25, 36 on the high side, and then 20 and 28. So the software is saying that this company is undervalued. Now, granted, like I can't really comment a lot on. Like this is a company that I would go and do like further due diligence on, because while these numbers are exciting to see, this is outside of my circle of competence. So for me, I would definitely have to dig deeper. But based off of these numerics here, it's showing that it's a buy. Now that doesn't mean that you should go out and buy it. You have to definitely do your due diligence. Assuming these revenue growth numbers would get you your 13% return. Now, out of curiosity, I'm going to run a few more numbers, and I'm going to make those numbers 4, 5, and 6. So we lose our conservative estimate, and these are all numbers that don't exist in here. And that's minimal growth, and we're still getting a $17 price average on our discounted cash flow. It's selling at such a low multiple already, so anything kind of above these numbers, it's gonna probably trigger to be a buy. I'm kind of curious if I bring this down. This company actually piqued my curiosity a lot, because I really am curious. Like what if we did still a buy, guys? Still a buy at a PE of 1, 2, or 3. We still have it at $15.24, still higher than our current price. So it's pretty much trading at best like super undervalued, at worst at fair value. Yeah, kudos to whoever recommended this company. Thank you so much for recommending. This is actually phenomenal. I mean, it's outside of my realm, but I definitely would. I'm gonna start doing a little bit more research and just try to see if this is something worth owning, because right now the numbers are speaking to me. But yeah, there's definitely more research to be done. So guys, those are my thoughts. If you haven't done so already, hit the like button and the subscribe button. Thank you so much for watching this video. I'll see you in the next one. Take it easy.